Okay, this is chapter number 6, and we're going to take a look at the first problem. But before we do that, I want to remind ourselves what exactly we're trying to do in this particular chapter. We're trying to come up with the ending inventory. Ending inventory in the terms of a dollar value. Now, inventory, there are always two issues. One is the quantity, and the quantity comes from having to count up what you have. The issues of quantity would be, and we've talked about this in the objectives, but I want to repeat it again. The quantity is, do you own the goods? If you are buying goods and they are FOB destination and the goods are in transit, well, if it's FOB destination, they're not your goods until they are at your warehouse. However, if you are buying goods and they're FOB shipment point and they're between the seller and you, they are your goods, the buyer. And you will put them in the quantity right there. Consigned goods, that was another issue. Remember, if you have put your goods with somebody else, you are the consignor, they are your goods. If you're the consignee, the person who holds somebody else's goods, they're not your goods. They do not go in that calculation. And the last item happens to be damaged or obsolete items. If they have no value whatsoever, you do not put them in the quantity count right there. Our focus isn't going to be on the quantity. Our focus is going to be on what unit price do you take times the quantity to get the inventory. There are 4 ways to come up with the unit price. Specific ID, weighted average, the first in, first out method. First in, first out is referred to as FIFO. And the last in, first out, which is referred to LIFO. So we're going to stop right now, and what I'm going to do is I'm going to put the problem on the board here that you happen to have in your handout. Problem number 1 that deals with inventory pricing. Okay, we are back, and we are taking a look at the first inventory problem. And you'll notice in looking at the facts that you have in your handout, beginning inventory is 0. And we happen to purchase, and we have 3 purchases. One on the 7th, one on the 14th, one on the 21st. And each of those tells us on the handout, we had 10 units at $7. So we paid a total of $70 for goods. On the 14th, we had 20 units at $8. So we bought $160 worth of goods. On the 21st, we bought 15 units at $10 a piece, or a total of $150. So, looking at chapter 5, this is going back a chapter. I know we're in chapter 6, but looking at chapter 5, you recall there was a calculation, cost of goods available for sale. This is the total amount that we could sell. That calculation was beginning inventory plus net cost of purchases. Our case right here, we started out with 0 inventory to begin with. So we start with 0, and we're going to add the total cost that we've purchased. That's this 380 right here. So we have 45 units that we could sell, and they have a cost of $380. Looking at the problem again, you'll notice that we had made 2 sales, one for 5 units on the 18th and one for 10 units on the 25th. So we sold 15 units. If you have 45 units you could sell and you sell 15 of those, that means our ending inventory is 30 units. Now that's the quantity. So we know that we have 30 units in inventory. We need to price that out. There are 4 ways to price that out. 1 would be the specific ID. 2 would be the weighted average. 3 the FIFO, and the 4th is the LIFO method. To have specific ID, what you need to do is you need to have some way to trace these 30 units back up to the units that you've bought. Well, that's only going to be possible for units, usually large units, that have some type of an inventory item. Automobiles, classic, computers, large appliances. And I think I mentioned in the overview Jewelry stores will always have a tag on each item of jewelry. That tag is an inventory tag. And if we had 30 pieces of jewelry here, it would tell us exactly where we bought that. Did we buy it from here on the 7th, the 14th, or the 21st? We could trace it right on back, and we could price out those goods. So what we're going to do now is we're going to stop, and I'm going to come back, and I'm going to tell you we're going to price these 30 units out under those 4 methods. Okay, we got the specific ID, and as I just indicated to you a moment ago, to determine the cost of the 30 units that we have in inventory, we need to specifically be able to trace them back to the purchase price. Let's, for our purposes today, assume that we had 3 purchases. Let's assume 1/3 comes from each of the purchases. That is, I have 30 units, 10 come from the purchase that is on the 7th, 12/7. If that's the case, those goods that were bought were $7 a piece. So I'll price those 10 units out at $70. Let's assume the other third comes from the purchase that's on the 14th. Those were bought at $8 a piece, so 10 units times 8 is $80. And then the last lot of 10 units that I still have were bought on the 21st, and those were at $10, or that's 100. So my 30 units that I have are a total of $250. That is, I have some at the $7, some at the 8, and some at the 10, total of $250. The last little bit on this particular problem I want us to look at is that we had goods available for sale of $380. That goods available for sale could all still be with us. If that is the case, all of it's in Indian inventory. Or it could all be in cost of goods sold if we sold everything out. Now, we don't still have everything, and we didn't sell everything out. So that 380 has to be a portion between what we've sold and what we still have. Now, I just calculated out what I still have. So if I had available for sale $380 worth of goods, and that was a total of 45 units, I have 30 units that are still with me, and I just calculated out that that's $250. So if you take the 380 less what you still have, 250, that means the 15 units that you sold have a cost associated with them of $130. Now, each of the 4 methods we have will be allocating this 380 to how much of it do we still have and how much of it goes to cost of goods sold. Under the 4 methods, we all have 30 units and 15 units were sold. We had a total of 45. 30 still with us, 15 have been sold. But the difference between the 4 methods are cost assumption differences as to how we track the cost. Specific ID, we look specifically at it. Weighted average, we average the cost out. FIFO, first in, first out. LIFO, last in, first out. And so because we have different assumptions, this 380 is going to be allocated differently under the 4 assumptions. Specific ID, only used when we can specifically track these 30 units to when we bought them. We're going to come back in a minute. We're going to take a look at weighted average. Okay, we're now going to do the weighted average. Now, what I have done is I've come back to this original problem that I put up on the board to show you that we had 3 purchases and we sold 15 units. Now, those sales took place actually at 2 different times. We happened to sell 5 units right here on December, I believe it to be, 18th. And then we sold 10 units on December 25th. Under the weighted average, and this is a moving average, and so what it means is every time that you sell goods, you must come up with a new average. So if every time you sell goods you need to come up with an average, how many times are we going to have to calculate out an average in our particular problem we have behind me? Well, we had 2 sales. That means we're going to have to come up with averages 2 different times. And so what we're going to have to do is we're going to have to come up with an average for these first 2 acquisitions because we made a sale right here. Then that average is going to be rolled forward and re-averaged before we make this sale on the 10th. So if we'd had 10 sales during the month, how many times would you have to come up with a new average? 10 times. Since we only have 2, only 2. But it's a moving average. You come up with the average, you move forward, and that average is re-averaged again. Move forward, re-average, and so on. Right? So I'm going to be back in just a second with the first calculation, the first average right here. Okay, as I've just told you, that every time we sell goods, we have to re-average the goods. So on the first sale that took place on the 18th of December, we sold 5 units. At that point in time, we need to come up with our average cost of the goods that we happen to have. And on the 18th, we happen to have had 10 units at $7. We happen to have 20 units at $8 or 160. So we had 30 units at $230. We have to come up with the average. Well, pretty easy. If you've got 30 units and they cost you a total of $230, divide them out, the cost divided by the units, gives me an average cost of $7.66,666. It's a repeating 6, so I rounded off, and I rounded it out about 4 places. Most students ask me at this point, how far do I want you to round things out? Well, first of all, on a quiz or an exam, if I tell you, do what I tell you. If I don't tell you, it's best to round it out about 4 places, not only in accounting 210 or 201 and 202, but 203 as well. Almost all of those, if you round out 4 places, you'll be right on the money. So I have $230 of goods available for sale. I happen to sell 5 units, and I've abbreviated cost of goods sold, COGS. 5 units. Those 5 units are priced out at $7.666, approximately $38. The inventory I still have, which would be 25 units, I had a total of 30, sold 5, still have 25. Those units are priced out at my average I just did of $7.667 or $192. Now, what I'm going to do is I'm going to buy more inventory. And so I am going to roll forward these 25 units at this $192 cost. And I'm going to have to use that with the new units that I buy to re-average the average. It's a moving average. It's an average that moves forward and is averaged in again. So we'll be right back, and we'll take a look at the second average when we sell the goods at the end of the month. Okay, so now what we have to do is we have to re-average the average for the sale that took place right at the end of the month. And at that point in time, just before we sold the goods, we happen to have those 25 units that we had just had left over from the first sale, and those were at $7.6667 or $192. Now, we're going to use that when we buy more goods, and we bought more goods on the 21st, 15 more units at $10 a piece or $150. So just before we make that sale of 10 units right at the end of the month, we had 25 and 15, 40 units, and those 40 units had a price of $192 and $150 or a total of $342. So just before I sell, I've got to re-average my average. The average, $342 divided by 40 units, $8.55. So the goods that I have are averaged out at $8.55. The cost of goods available for sale is the $342. How much of that am I going to keep? I'm going to keep 30 units. I'm going to sell 10. Again, COGS, cost of goods sold. Those 10 units I sold are going to be at $8.55. That means 10 times $8.55. I recognize that's $85.50, but I have rounded. I've rounded to $85. The units that I have left at the end of the period of time, which are 30 units, those 30 units are priced out at $8.55, and that's $257. Again, it's rounded just a little bit. Some of you might say, well, am I supposed to round or not? What if I round? What will you do on a quiz or exam? Show your work. Everything will be fine. All right. So, weighted average. When do you average? Just before you sell goods. And then that new average rolls forward and is averaged in just before the next sale. And it just keeps going. Now, this is the method that is used most often of the four methods. The reason it's used most often is because we're just averaging things out. And with the advent of computers, it's very easy to average things constantly as you're buying and selling goods. All right, we'll be right back and we'll take a look at the third method. Okay, we're going to take a look at the FIFO method first. Now, up here I have indicated first in, first out. Now, under in, I have put the word buy. So the first that you buy is the first to be sold, or the first that you sell. And this method then assumes that the items you're buying first are the items that you sell first. There are some businesses that actually their goods, in fact, do flow this way. You think about it. A grocery store. The first goods that they buy are the first goods that they, in fact, sell. Have you ever gone back to the milk area in the back of the store? You know, you might want to try to reach around and get the goods that are way in the back because you know those are the freshest. But they put it so you can't reach around there anymore. They're on a level, they're on an incline, so you grab the first one, everything flows now to the front. They know that the first goods that come in, that they buy, have to be the first goods that they sell. Because if the oldest stuff is still there, it's going to spoil and you won't be able to sell it. Now, your goods do not need to flow this way to use this method. This is just a cost and assumption. Let me give you an example of the FIFO method with the facts that we have. First of all, in here in black, we have bought on the 7th 10 units. On the 14th, we bought 20 units. On the 21st, we bought 15. But here in blue, I've put that on the 7th, it was not the 7th, it was I believe it was the 18th, it may have been the 15th, but it really doesn't matter. We sold 5 units. All right, under first in, first out, the first goods that come in are the first goods to go out. So, where do these 5 units come from? These 5 units, the first goods to be sold, came from the first that we've bought. So these 5 units came from these 10 units right here. So I'm going to go and I'm going to say right here, inventory, and I'm going to hear cost of goods sold. And these 5 units come from these 10 right here. So I'm going to put 5 units. And that leaves us now with 5 units from that first purchase. All 20 units I have here are still with me. I drop down and I buy 15 more units right here. I'm going to put those in inventory. But now I'm going to sell 10. This is the makeup of my inventory right now when I sell these 10. Under FIFO, where do these 10 units come from that go into cost of goods sold? Well, let's take a look. First in is the first to be sold. So of these 10 units, 5 have got to come from this beginning lot right here. So now I have 10 units, 5 from the first sale and 5 from the second sale. All of these are gone, nothing's left. So where do the next 5 units come from? So 5 came from here, 5 of these came from this purchase, so I still got to count for the rest of the 5 units. Where do they come from? First in, first out. So now, of the 15 I had in inventory, 5 go into cost of goods sold, and I'm left with 15. How many do I have units at the end of the period? 15 and 15, that's 30 units. So when I go to price out my ending inventory, which I will do here in a second, 15 will be at the $8 and 15 will be at the $10. How about my cost of goods sold? 10 units will be at the original price of 7 and 5 units will be at the second purchase of 8. And that will how we figure out cost of goods sold. So come on right back and I'll have that priced out for you and I'll show you how that works. Okay, so when we go to price out what we have left at the end, we can see that we have 15 units left from the acquisition on the 14th. Those are $8 a piece, so that's 120. We have 15 units remaining from the December 21st acquisition at $10. That's 150. So my total ending inventory is $270. My cost of goods sold, remember I had 5 units that I sold, and then I sold 10 more, but when I priced those 10 that I sold, 5 of them came from the first acquisition. So now I have 10, 5 and 5, and they're all at 7, so that's $70. And then the second sale, 5 of those units came from the second acquisition at 8, or $40. So my cost of goods sold is 110. Now, kind of working backwards this time, ending inventory and cost of goods sold, if those two added together, they're going to give me 380. What does that 380 represent? That's the cost of goods available for sale. I had $380 that I could sell. I still have 270. That meant my cost of goods sold is 110. So that's FIFO. First in meaning to buy, is the first out. Out meaning to sell. So first ones you buy are the first ones that you sell. We're going to come back and we're going to take a look at the last one, which is called LIFO. Okay, we're going to take a look at LIFO, last in, first out. And again, as you see up here on the board, last in is always meaning buying. So the last goods that you bought then are considered to be the first goods that you are going to sell. Now we have to do LIFO in real time. And what I mean by real time is every time that we make a sale, we have to detail out the layers of our inventory. So we may have a sale, first sale we have in our example is at $12.18. We're going to sell 5 units. When we sell those 5 units, these are the layers that we have. We have the purchase from $12.7 at 10 units at $7, and at $12.14, 20 units at 8. Last in. So which are the last goods to come in? Because they are going to be the first goods that we sell. So these 5 units are going to come from the last units that we have purchased. Well, if you can see the dates and the units, very easy. These 5 units are going to come from that layer right there. That's the last layer that came in. And so that means these 5 units come from there. So when I price my cost of goods sold, these 5 units are going to be priced out at $8 a piece. So that means if I sold 5 units, those 5 units come from those 20 right there. And that then going forward is going to leave me not with 20, but with 15. If this is my inventory, and this is my cost of goods sold, these 5 units come from here, which mean they go into cost of goods sold at $8 a piece. Then what happened? Well, and I'm going to erase this right here. When we get down to the end of the month, we're going to sell some more units. But in the meantime, I laid out another layer. and that other layer was on 12/21. I bought another 15 units, and those 15 units were at $10 a piece. And then right at the end of the month, on the 25th, I sold 10 more units. So again, last in, first out. Last in means to buy, first out, out means to sell. So the last layer that I bought is where these 10 units are going to come from. Looking at the layers that I have here, where do those 10 units come from? Pretty straightforward. They come from that layer right there. So when I say in cost of goods sold I have 10 units now, what are those 10 units going to be priced out at? $10 a piece. And when I say priced out, that doesn't mean what I'm going to sell them for. I sell them for something quite a bit more than that. But remember, every time I have a sale, I have to have a journal entry for the sale at the retail price. I also have to have a journal entry for the cost of the sale. And what I'm talking about here is how do we come up with that cost? In this case, those 10 units will be at $10 a piece. So what does that leave us with then in the end? I'm going to erase that 15 that was there because I just sold 10 of those and I'm only left with 5 left. So how many units do I have in ending inventory? I have 10, 15, and 5. That's a total of 30. And how do I price those 30 out under LIFO? 70 for this layer. This next layer is going to be 8 at $15 a piece. And I believe that to be $120. This last layer is 5 units at $10 a piece, or $50. You add that up, and that appears to me to be $240. So under the LIFO method, my ending inventory is $240. So the cost of goods sold then, we're going to have 5 units at 8, that's 40. We're going to have 10 units at 10, that's 100. So the cost of goods sold for the period of time that we're looking at is 140. Again, just as we did in the FIFO method, we said our ending inventory and our cost of goods sold, those two added together will give us our goods available for sale. So 240 plus 140 is 380. And sure enough, that has been the total cost of the goods that is available for sale. Of that, 240 is still with us, 140 is what we sold. We're going to come right back and we're going to compare all of the 4 methods and look at one little thing as to LIFO and FIFO. Okay, what I want to do now is I want to compare the 3 methods using the problem we just worked out. Up here on the board you'll notice that I have put goods available for sale, ending inventory, and cost of goods sold. Now, under every one of these 4 methods, I have across the top $380 because the goods available for sale under each of these 4 methods was all the same. The difference was, of the 380, how much is going to be allocated to ending inventory and how much is going to be allocated to cost of goods sold. Now, cost of goods sold is an expense. And because it is an expense, and we're going to have different cost of goods sold on each one of these, that means the income statement is going to have a different amount of expenses. Different amount of expenses is going to give us a different amount of net income. And so we're going to stop here, and then we're going to come back, and I'm going to have filled this out, and I'm going to show you the impact of these 4 methods and the impact on the income statement. Okay, so what I've done now is I've kind of filled out more of my chart that we're going to be looking at. And on the top here, what I've done is in blue, I have filled in the amount of the ending inventory and the amount of the cost of goods sold. These are the exact same figures that we just calculated when we did the problem. And we have the dollar amounts there that are in blue. Now remember, those blue figures, if we add each of them together in each of the columns, they will add up to the cost of goods available for sale at the top. Give you an example. In the specific ID column, that's the first one there, we have ending inventory of 250 and cost of goods sold of 130. Those two blue figures added together equal 380. You will find that to be the case in each of the columns going across. Now, here on the bottom, what I have is an income statement. Sales, cost of goods sold, gross profit, operating expenses, net income. Now, from Chapter 5, I asked you to memorize and to know this particular calculation for net income. We're going to assume that the 15 units that we have sold in this problem, although not stated, we're going to assume that we sold those goods for a total of $180. So I have put across the top $180. We're going to fill in what the cost of goods sold happens to be. And so the cost of goods sold up above will be brought down and put in each of those columns. From there, I will determine gross profit. I will assume that we have a fixed amount of operating expenses, so it doesn't really matter which method we use. We'll have the same operating expenses all the way across. And then we'll calculate out net income. So I will now stop the tape and go and fill this all in with the assumptions that I'm going to be making. Okay, I've now filled in the bottom part of our schedule, and I have assumed that my operating expenses are a total of $20. You'll notice that the only thing I've really done is I've brought the cost of goods sold down, and you can actually see an arrow. So the 130 under specific ID just comes down and fills in cost of goods here. I deduct the 130 from my total sales, that gives me 50. I deduct out the 20 from my operating expenses, that gives me net income of 30. I have done that with each of these columns. Looking across the bottom, you'll notice that the net income is different, going from a low under LIFO of 20 to a high in FIFO of 50. Yet, I sold the same number of units. You'll notice sales is the same all the way across the top, but the net income is different. Why is that? It's different because the cost of goods sold is different. It's different because the inventory amount that is left on the balance sheet at this point in time is different. So what it says to you is your inventory method can make an impact on the amount of net income. Now, the last thing I want to talk to you about is LIFO. In times of rising prices, when prices are going up, in our example, our prices were going up. Our first acquisition of inventory was at 7. Our second was at 8. Our third was at 10. Inventory prices were going up. As inventory prices are going up, LIFO will give you the lowest net income. Which one is the lowest here? LIFO. Now, if inventory prices were going down, if the first acquisition was at 10, and then at 8, and then at 7, it would be just the opposite. LIFO would give you the largest net income and not the least amount. So, starting back in the 1960s, when prices started to go up, and they went up consistently in the 60s and the 70s, and actually even in the first part of the 1980s, a lot of companies chose LIFO because if prices were going up, which one would give you the lowest net income? LIFO. Why would a company want their income to be lowest? Oh, taxes. Because lower net income would mean less to pay in taxes. Well, the Internal Revenue Service and Congress said if you use LIFO for tax purposes, you must use LIFO for financial purposes. Well, that meant that you may be paying a less amount of tax, but you'd also be telling your shareholders, I didn't make as much money. So, although some companies use LIFO, probably more of them use FIFO than LIFO. And most of the companies don't use either. Most of them use the average cost, which kind of gives you a figure pretty much in the middle, 37 in our example. It averages out when prices are going up and when prices are going down. One industry that I know of, because I worked in it, the oil industry, Yeah, I've got oil on my hands and underneath my fingernails. That industry uses LIFO because over time prices of oil have gone up. Every now and then prices will shoot up and then they'll come back down. On the way down, you hear oil industry has record profits. Why? Because when prices are falling, LIFO gives you the largest net income. I want you to know when prices go up, LIFO gives you the lowest and FIFO will give you the highest. When prices reverse, it's flipped around. I also want you to know for tax purposes, if you use LIFO for tax, you've got to use LIFO for financial. So this is what I need you to know. I need you to know how to calculate out ending inventory under FIFO, LIFO, weighted average, specific ID. That's what your next quiz is going to be on, and that will be on your next exam as well.